Good morning, everyone, and welcome to the Bluesource webinar on COVID's impact on carbon prices and voluntary greenhouse gas commitments. My name is Lizzie Aldrich, and I'm the Vice President of Business Development at Bluesource, and I'll be moderating this webinar. We're excited to talk about this timely topic and hope you and your loved ones are staying safe during this time of COVID. Before we begin, just a few housekeeping items. If you have a question during the session, please write the question in the chat function and send it specifically to the panelists, and we'll do our best to address all of the questions after the presentations. The webinar is being recorded, and a link of the recording will be sent to all who registered for the webinar. And if you do not already receive our newsletter, which gives updates on voluntary carbon market trends and provides information about upcoming webinars, I encourage you to sign up at the bottom of our homepage at www.bluesource.com. Today we have 4 speakers. Each speaker will present for 15 minutes, and then we'll have a Q&A session. First, Kevin Townsend, Chief Commercial Officer at Bluesource, will discuss the impact we have seen thus far of COVID on North American carbon and renewable fuel markets. Next, David Antonioli, Chief Executive Officer of Verra, will talk about any impacts from COVID that have been observed by Verra and the VCS program. And finally, Beth Wattias, Senior Vice President of Environmental Operations, Director at Bank of America, will discuss COVID's impact on voluntary corporate greenhouse gas mitigation strategy. And with that, I'm going to pass the mic over to Kevin Townsend of Bluesource.
Thank you very much, Lizzie. And thank you everyone for joining us. We're going to begin our talk today looking at some of the compliance markets for environmental attributes around the continent, what impacts COVID has had, and what we might expect for the future. Before I dive in, just a quick note on Bluesource, who we are. We've been around for about 20 years, and we've developed a lot of projects that create these environmental attributes along the way. We really try to be a partner to our clients. We know that environmental action is tricky, and whether you're doing this of your own accord or you're trying to navigate a complex web of regulations, a partnership approach we feel is really valuable. As a retailer, we try to take our boots on the ground experience from developing hundreds of projects and apply them to a network of trusted suppliers so that we can ensure quality and integrity in everything that we do. And lastly, innovation is really core to who we are. These markets have always required leadership and probably will well into the future. If you have a direction, a new idea or a new direction that you'd like to take, or if you just want to make sure that your company is perceived as an innovator and a leader, then we'd love to work with you. We've got about 45 folks in our organization, mainly in the offices at the bottom of your screen here, but scattered around in various remote places as well. And with that, let's dive in. We're going to look at 4 markets. We're going to look at 2 different offset markets, the California and Quebec Cap and Trade, also known as the WCI, and we're going to look at Alberta's program. We're also going to take a look at a couple of renewable fuel standard markets, the federal RFS and the California Lcfs. There are certainly other markets for environmental attributes out there in North America that have been affected by COVID, but in the interest of time, this is where we'll focus our attention. So diving into the Western Climate Initiative, we're just going to take a look at the price history here for 2020. For allowances and offsets, just to set the stage. We're going to come back to this, but I'm going to focus my topics on offsets, but you really can't talk about offsets without talking about allowances in the Western Climate Initiative. And that's represented by the top line here. And really what you can see is that there was a pretty dramatic price collapse and slow recovery beginning in March and April. So when I think about COVID-19 as in terms of its impacts in the Western Climate Initiative, I really view it as both a catalyst and a contributor. And if you recall back to your high school chemistry days, a catalyst is something that it starts a reaction, but it doesn't actually participate in that reaction itself. And I think COVID has done that in a number of ways in the California Cap and Trade. It's gotten people to think differently about things that are actually not even related to COVID. But it has absolutely been a contributor as well, and we're going to talk about that. So as a catalyst, in that previous slide, you really saw a sell-off of CCAs and the price collapse there. And CCAs provide a price ceiling. And when I say CCA, I'm referring to California Carbon Allowance. And if I say CCO, I'm referring to California Carbon Offset. Kind of use those interchangeably. But CCAs provide a theoretical price ceiling on offsets, okay? And a price collapse in one definitely affects the theoretical price of the other. We'll go back and talk about what that really means. COVID has also caused buyers to think about some issues that have been out there for a long time in a different way. And those two issues have mainly been the change in offset utilization rate from 8% to 4%, and this issue of DEBs, which is direct environmental benefits to the state of California. I'm not going to go into either of those here, but suffice it to say that there's not any new news about those things, but the market is thinking about them very, very differently. They also don't affect the market right now, they affect the market of tomorrow. These are both post-2021 issues that I think COVID has people thinking about more now than they ever have before. And then lastly, due to the price collapse in allowances back in March and April, there have definitely been some trading restrictions placed on certain market participants. And that was a tough time for many. There were margin calls, it became very expensive and very difficult to hold open positions and allowances, and that absolutely trickled down into the offsets. Now, as a contributor, COVID's greatest impact has been on fuel emissions in the state of California. Fuel emissions represent, or the fuel sector represents about 80% of offset demand to date. Now that's not to be confused with 80% of California's emissions. That actually does represent about that much of the offset demand. And when you see a 30 to 40 million ton reduction, about a 10 to 13% drop, because as we all know, not a lot of people are traveling right now, then that's absolutely going to have a negative impact on demand for offsets in this space. The other thing that COVID has done is it's shaken people's confidence in the program. Now, I want to be careful about this because it's not that anyone doubts how resolute California is in meeting its climate goals, but if you look at the greater economic picture and what's happening during these crazy times, if something's got to give, questions are being asked, will it be this program, or is this program really here to stay? So let's go back and take a look at this price history, and this time we're going to take a deeper dive. Now, I want to point out that the blue line for allowances is based on very good data. These are exchange-traded products that move almost every single day. That is not the case with the green line for offsets. There's a lot of opacity in this data, okay? And so this curve, this price history is based on actual market data points, but it's also based on just a ton of assumptions about how offsets relate to allowances at any moment in time. And because of that, we really don't know what happened with offsets during this crash, but it probably wasn't this. It probably was not what you see here. It probably looked something more like this, okay, a more steady decline. And the reason is this, it's probably twofold. One is that sellers of offsets don't have to react as fast as they do for allowances. Sellers can generally sit tight on their supply for a while. Now, I'm not saying that some trades didn't happen down on this green curve here. For example, if credits had been pre-sold on an index structure to allowances and were issued during this time frame, then that seller may have been forced to sell at these lower prices, representing a true momentary discount. But the other thing I want to point out is that offsets generally react to changes in allowances much slower. There is often a 3 to 4 week lag, at least, between a dramatic change in allowance prices and a dramatic change in offset prices. And why this is important for the future is that if we see increased volatility again in the allowance market, we can probably expect a slower, smoother, and more delayed response from the offset market. The next thing I want to point out is what has happened with the spreads between the beginning of 2020 and where we are now. We began this year with about a 16% spread, and we are currently sitting at about a 25% spread. And when I say spread, I mean the discount that an offset receives relative to an allowance. So why is it? Why are we now at 25%, representing about $1.35 of value, which is a lot? Well, it may be because of the 4% issue and the DEBs issue, which I meant before. And to put a finer point on it, it may be that participants are concerned about oversupply in the market. And so the offsets are fundamentally worth less, or perceived to be worth less relative to an allowance. But I actually think that there might be something else going on here. The price ceiling concept is very well understood in this market, and it makes a lot of sense in that an allowance at any moment in time would be worth more than an offset at that same moment. But the market tends to view it in a very momentary way. We say that at this point in time, an offset should be worth this much relative to an allowance. But I actually think that maybe what we're seeing here is less of a price ceiling and more of a price balcony effect. And so that's represented by this blue dashed line here. Now, indulge me for a moment. A balcony, if you're standing below it, is an extension of a ceiling. right? It's an extension of a ceiling far out over something maybe where it doesn't belong, or in this case, maybe it's a time horizon. Okay, and if you are hypothetically a compliance entity that took advantage of the price collapse in March and April, and you were able to procure a large number of allowances at, say, $13.50, well, here we are months later, but a $13 offset price is probably a lot less attractive to you than simply comparing offsets against the current spot price of around $17. So it's this balcony effect that I think might be going on, and there's a question mark about how long it will last. So what now? What's next for COVID's impacts on the WCI market? Well, we've got quarterly allowance auctions to contend with, and just last week we received our results for the third quarter auction, and it was the second in a row to be undersubscribed, which tells you that people are still very much thinking about COVID's impacts on the actual sectoral emissions in California. That continues to be an important consideration, and the story's not written yet, right? We still have months to go in 2020. The other thing I want to point out is that there's only one more chance for buyers to buy allowances at the current floor price before it increases next year. And projections would say that that's probably going to be at least $17.60. So when we think about how long the balcony effect might last, if it's even a real thing, is if you're a compliance buyer staring at $17.60 as your next procurement cost, then a $13 offset starts to feel much more attractive with that $4.60 spread. The last thing I want to point out with respect to this market is that we have one very large event left before some of these regime changes occur for offsets, and that's the triennial surrender date in November of 2021. Now, the last time we saw a triennial surrender date was in November of 2018, and the spreads, the discounts between offsets and allowances really compressed to about 10%. So will we see that again? Or will people be concerned enough about oversupply that those spreads stay wide? When we think about oversupply, there's a real question about whether or not people will act and behave based on short-term views or long-term views. And I want to point out that actually, I think that there, even in the presence of short-term oversupply, that has actually been the case in this market for most of its existence. But people have often made their purchasing decisions based on the long-term views of the market. So I think that buyers will start to ask themselves, even if short-term oversupply exists, what does the supply and demand balance look like at 2030? What does it look like at 2025? And start to think about the program over the course of its life. The very last thing I'm going to point out is that the utilization rate of offsets for this compliance period 3, which will be marked in November of 2021, is very important. At the close of CP2, the utilization rate was 6.4% out of the allowable 8%, and it'll be very interesting to see how much that increases for CP3, because it will likely be a forecaster of future compliance period utilization rates. With that, I'm going to go ahead and move on. We're going to turn our attention north a bit to Alberta. So what happened with respect to COVID in Alberta? Not much, actually. This might be one of the only markets in the world where COVID is an afterthought. And really, any negative impacts are overshadowed by a few things. The first is that the program itself is designed in such a way to insulate itself from economic hardship. It is actually an intensity-based program. It is not a hard cap like WCI. It is not an economy-wide cap on emissions. Instead, what Alberta's program demands is that the amount of greenhouse gas reductions per unit of production decreases over time. And so that means that the program actually still does really solid environmental work and still demands change even amid economic decline. The other real factor in the Alberta market is that the prospects of linkage with the emerging federal program are strong, and this has provided a lot of bolstering to the offset price and the price of all instruments in that program. Really, you have a pretty stout price floor that escalates by $10 a year. And in the 2020 compliance year, it aligns well, aligns perfectly with the federal program, but that's going up by $10 per year over the next 2 years. And so people are definitely watching that closely. And the very last thing I'm going to point out in Alberta is that there's a convenient timing factor here with respect to when COVID hit the hardest. And you can call it an alignment, you can call it a misalignment. But COVID really hit hard in about March, and most compliance entities had already implemented their procurement strategies for that compliance season, which ended on March 31st. It was later extended by the Alberta government, but it didn't really matter. And so COVID has just managed to hit hardest in a time of very little market activity. We're now going to look quickly at a couple of renewable fuel markets, and in the interest of time, I'm going to summarize the issues of both the federal program and the California Low Carbon Fuel Standard. Both of these were hit hard by COVID and resulted in initial price shocks, which have mostly recovered. But there is still absolutely the question about demand from reduced fuel consumption. That in a renewable fuels program, that is maybe the most important factor. However, COVID is not the most important factor in either of these markets. You really have other things that are driving the market activity. And in the federal space and in the RIN market, really these are policy and political drivers. The issue of small refinery exemptions just continues to sort of plague the market or beat it over the head with the news cycle. And the market trades generally pretty emotionally around the news cycle around small refinery exemptions. Also, you have generally a pandering to the oil lobby of the current federal administration. And so if there's a change, it's likely going to be bullish for the RIN market. And if Trump maintains the White House, it's likely going to be bearish. The one thing I'm going to note about RINs, a particular segment of the RIN market, which is cellulosics, is that the lower gasoline prices that we've seen in 2020 will result in a higher cellulosic waiver credit, or CWC, in the future. And if you've traded in this market, you know that there was a time that cellulosic RINs traded at a discount to the CWC. And if that happens again, then a higher CWC is going to be a very material factor. Lastly, looking at the Lcfs market, like the RIN market, this is facing a much larger issue than COVID. And right at the bottom here, you can see that there have been two announcements by Phillips 66 and by Marathon of converting large refineries into renewable diesel. Now, these two refineries represent a 1 billion gallon swing in the market, which is quite substantial. And it's a double whammy. It's actually not just a loss of demand because these refineries used to need Lcfs credits, but it's actually that they will be producing Lcfs credits from their renewable diesel. So it's actually a withdrawal of demand and increase of supply from these decisions. And those are a few years out, but the market is absolutely thinking of them. And with that, I'm going to stop and I'm going to turn it over to David Antonioli of Verra. Thank you very much for listening.
Great, thank you, Kevin, and welcome to everybody, and thanks to Bluesource for inviting me to speak on this webinar. It's a pleasure to be here. I'm going to share my screen now, and you should be able to see it momentarily, and hopefully we get it going. I think it should be there. What I hope to speak to today is really just to give you guys a sense of what we see is happening in the market, in the voluntary carbon market, under the COVID pandemic. Spoiler alert here, I think generally we see that the market is really quite resilient and sustaining, but there's been some ups and downs, and I hope to illustrate that for you guys, both looking at some historical data and some more recent data from our registry. Just quickly about Verra, we're a nonprofit organization, and we manage a family of standards for a sustainable future. And those include the Verified Carbon Standard, which is the most popular offsetting standard in the voluntary carbon market. We also manage the Climate, Community, and Biodiversity Standards and the Sustainable Development Verified Impact Standard that help projects demonstrate that they're generating sustainable development benefits or impacts. This is a slide from the Ecosystem Marketplace, the most recent report, just illustrating how important standards are to the market and making sure that there's credibility behind the transaction, the credits that are being transacted. You see here illustrating that, again, the VCS program is we're the largest one, but the other standards as well help to provide the integrity that the market needs in order to continue to transact and to go forward. This also is from the Ecosystem Marketplace. This is a historical graph of issuances over time and then retirements. And as you can see, the market, throughout the early 2010s was growing at a decent clip, but that pace has picked up significantly over the last 2 years. And we've seen the similar aspect or similar trend in respect of VCU issuances. So VCUs are verified carbon units. Those are the credits that we issue. And this graph is broken up into two different kinds of projects. So the blue line shows what we call non-natural climate solutions. So that tends to be stuff like energy sector, industrial process reductions. And the green line is NCS credits. Again, those are stuff related to agriculture and forestry. And we've crossed an important threshold in 2016 where that number flipped and we saw a greater number of NCS or AFLU issuances being issued from our program. And I think that was indicative of a number of different elements. I mean, just to illustrate what that meant, in the early days of the voluntary carbon market, the credits tended to come from renewable energy projects, landfill gas projects, and HFC or N2O emission destruction projects that were based on industrial facilities. But as the market has moved over time, there's been an increasing attention and interest in credits from natural climate solutions. Initially, those tended to be RED, so RED stands for Reduced Emissions from Avoided Deforestation and Forest Degradation, and those tended to be the earliest kinds of NCS credits that were in the market. And were very popular. But more recently, we've seen an increasing interest in restoration and removals. ARR, those are afforestation, reforestation, and revegetation. There's a lot of interest in blue carbon, mangroves, wetlands restoration types of activities. And there's now an increasing interest in agricultural land management. So it'll be interesting to see how the market plays out. But we do see a strong trend towards more natural climate solutions. And I think that if you think about why this is happening, I think there's a couple of reasons. One is that these kinds of projects generate a lot of benefits. And the other one relates a little bit to where activities can happen. So I like this graph. It comes from the ICAP, the International Carbon Action Partnership, and it illustrates of a number of different markets around the world, what sectors are actually covered. And as you can see, in the majority of these markets, the sectors that are always covered tend to be power industry, buildings, transport. And only in New Zealand is forestry covered. And the graph doesn't even show agriculture. And I think that speaks to the fact that these sectors, agriculture, forestry, tend to be harder to regulate. And as you think about, the way we look at the world, which is as a standard setting body, one of the first criteria that you need to look at for a project is whether it meets the test of regulatory surplus. Is it required by regulation? So as we start to think about 2025 and 2030, as governments start to regulate their greenhouse gas sectors, they are likely to start to regulate the point sources, the large sources of emissions like you see in this graph. And that means that there will be increasing space or limited space in those particular sectors to generate offsets. But still, you'll see quite an opportunity for projects in the land space. So again, agriculture, forestry, and other land use. The other important thing to keep in mind, of course, is that most corporates plan to use carbon credits as part of their climate strategy. So this is the graph from the IETA Greenhouse Gas Market Sentiment Survey that was published recently. And again, companies are saying we still want carbon credits. We still need carbon credits to meet our targets. So this is an important indicator suggesting that there's still demand for carbon. And I mentioned this before, but one of the really important things that we see in respect of carbon is that natural climate solutions also tend to provide more than just carbon. And many projects actually end up generating a lot of very tangible and measurable sustainable development benefits. And you see here just a number of different benefits that many of our projects have actually been able to generate. So they've been able to work with farmers to provide more efficient farming practices, thereby reducing pressure on forests. They provided additional sources of income. They provided jobs. They provided schools, clean water. And these are just a small handful of a number of other benefits that projects provide that also really help to, create value for what these projects are doing beyond just reducing greenhouse gas emissions. So turning over to kind of what we see now from VCU issuances, this is a graph where we looked at issuances throughout this year. And interesting, this is actually mirrors the graph that you showed, Kevin, in terms of the pricing. But you'll see that issuances, which is the total issuances, the gray line at the top, were incredible, really high. Again, first 3 months, January, February, March, and March was a very high year. But then they dropped in April. I don't know that had to do with COVID directly. It's hard to tell. But the interesting thing is that the numbers seem to be picking back up. Now, maybe it was due to COVID. Maybe it's just the way markets work. I don't know. But the other curious thing here is that you start to see, again, greater demand for non-affluent credits, which is different than what we saw before in the trend that we saw through 2019. But that seems to be correcting itself or coming back to what we saw before with the July numbers. It's hard to tell a trend from a limited number of data, say 6 or 7 months like we have here. But I did want to share this with you guys to show, what we see. I mean, ultimately, I think that what this shows is that there's a lot of indicators in the market that are pretty important. And what we see is that airlines, although demand is down for sure, airlines are not walking away from their bold commitments. You've seen commitments by Delta, EasyJet, JetBlue, a number of airlines who are saying, look, we're doing this, we're going to continue with our commitments, and we're going to continue to purchase emission reductions to address the emissions that we can't avoid. The tech sector is doing very well, and they're actually they're doubling down on their sustainability commitments, and there's been a lot of really interesting announcements recently. Microsoft's RFP to procure carbon removal from nature, as well as technology-based solutions. There's the Amazon commitments, Stripe. The tech sector is doing very well, and they're doubling down on this. So that really generates a continued demand for credits. The oil and gas sector, I think that there's going to be reduced demand in the short term, but over the long term, we again see them not walking away from very strong sustainability commitments, particularly with companies like Shell, Total, BP, Eni, and some others. And then I think the interesting piece, and good intro here for Beth, is that you're starting to see the banking and the finance sector really start to engage. Again, some indicators of BlackRock note, there's a piece by Berenberg, there's a commitment by several banks to create the Center for Climate-Aligned Finance. And these are really starting to get the finance sector involved in the voluntary carbon market. And I think this is going to be a real potential game changer because it could bring potentially a significant amount of finance to bear on the problem. So some key takeaways from what we see in the voluntary carbon market related to COVID. We see that the voluntary market is incredibly resilient. Key sector not walking away. Again, the financial sector taking a closer look, and that could be a significant game changer. And natural climate solutions are likely to continue to grow. There's lots of interest in removals. It's structurally hard to regulate. And again, they can generate significant sustainable development benefits. I'll stop there. I'm happy to take questions later. And thank you very much for inviting me to join you guys. I'm going to pass this over to you, Beth.
Okay, great. Thank you, David. That was a very good setup. And thank you, Kevin. So I think Lizzie's going to pull up our slides for us. But in the meantime, I can go ahead and dive in. So thank you for this time to be here with you today. So I am going to give you an example of an organization who has set aggressive climate goals voluntarily and how we've gone about essentially achieving those goals. So in my day-to-day role, I sit within our environmental social governance group, and I lead what we call our environmental operations work, which really is working across our operations as well as, of course, our value chain to really understand our impact and find ways to reduce that. And so a lot of the work that I do is making sure that we maintain our carbon neutral status, and I'm going to walk you through kind of how we got there and where we plan to go from here. So thank you. I'm seeing the slides now. Perfect. So this just gives you an overview of what ESG means here at the bank. There's a lot of information here, but really just to summarize, through ESG, we engage the communities we serve to drive economic mobility, social equity, and environmental sustainability. And the principles that you see outlined here really just guide us on how we treat our employees and our customers, how we manage risk, how we deploy capital, grow responsibly, and at the end of the day, just act as a good corporate citizen. So I thought it would be good if we go to the next slide just to give you an overview of our environmental strategies. So you'll see here 4 key pillars that we focus on. And within the environmental team, you know, the first part of our strategy that hopefully many of you are aware of is the business component. So we have recently announced our 3rd commitment in this space, which is $300 billion in low carbon business over the next 10 years. So that kicked off in January of this year. And that just really means that we are supporting the transition to a low carbon economy. So investing and lending in things like renewables, of course, energy efficiency, you know, helping to develop the green bond market and things of that nature. Another component of our work is operations. And I mentioned that that's the area in which I focus on. And so within that space, we have 13 public goals that we are trying to achieve by the end of 2020. And last year, we actually did reach our carbon neutrality goal and our 100% renewable goal. And we're continuing to work and drive progress on our emissions reductions and some of our other kind of facility and supply chain related goals. In addition to that, we have partnerships that we work with, groups that we work with every year. And so you'll see last year we provided $24 million in environmental philanthropic funding. And so that typically goes to universities doing climate research, as well as, of course, environmental nonprofit organizations. Then we have our people piece, which is one of the components I'm very proud of. We have a program called My Environment, which actually just celebrated its 10-year anniversary. And within this program, we have 24,000 members across 30 countries. And really the program focuses on helping employees act as better environmental stewards at work, at home, and in the community. One thing that you don't see listed here on this slide is our ESG risk work, and that work really is embedded throughout the organization. And as you can guess, focuses on managing climate risk as well as the various climate-related policies and things of that nature that we have. So if we move to the next slide, you know, hopefully that gives you a really good overview of kind of the breadth and depth of the work that we're doing and that we have been doing for a long time. But for the rest of today, I'm going to focus on this carbon neutral strategy so you can get a picture of how we've pursued this here at the bank. So this is just a high-level summary, but I think if you're going to pursue carbon neutrality, of course, the most important thing to do first is, well, of course, calculate your emissions. But once you've done that, really work to reduce those emissions. So you can see here that as of the end of last year, we had reduced our location-based emissions by 56% over the last 10 years, and we're continuing that momentum. We also have been working really diligently to purchase renewable electricity to cover our load across the globe, and I'll share a little bit more detail about that in a few minutes. And then finally, I know the piece that we're all here today to talk about, you know, really we have unavoided emissions that are left over once we've kind of done those first 2 things. And so that is what we purchase carbon credits for. And we'll talk a little bit more about that process. So if we go to the next slide, this just gives you an overview of how we have reduced our emissions. So we are using a 2010 baseline. So over the last 10 years, you'll see the 3 major components that have driven these reductions. So space reduction, we have a lot more space that we occupy than we did 10 years ago, so that has helped us significantly. We also have implemented multiple, I think over 16,000 energy efficiency projects all across the globe within our facilities, and so you can see that is driving emissions reductions for us as well. And you know, that's things like LED lighting, modular data halls, just a wide range of opportunities and things that we have pursued at our sites. And then finally, with this goal, we do benefit as the grid decarbonizes. So you can see kind of how much we estimate that has helped us get to that 56% reduction. If we move to the next slide, you know, the other really key component, and of course what we focus on for scope 2, is purchasing renewable electricity. So in order to pursue this goal, we first developed a strategy, or in many cases, a mission statement, which you see here. And our goal with this is to really support new renewables being added to the grid. So driving innovation, being efficient, but ultimately we want to be responsible for new renewables. And so you'll see here, this is kind of what I would call our anticipated renewable purchasing components. We're in the middle of this work, and this will, certainly carry us into next year. Last year was a big year for us. We actually did contract for over 550 megawatts of new renewables. And you'll see kind of how we focused our efforts outlined here. The first thing we did is we created a hierarchy of how we wanted to pursue this overarching goal. And the first thing that we focused on is on-site solar. So you will see we've committed to 60 plus owned sites. Those are in the process right now of being installed. Some slight delays with permitting, of course, because of COVID, but we are having multiple installations happening right now. So hopefully you'll see some solar panels at a site near you soon. In addition to that, and somewhat simultaneous, we also worked with our tax equity partners here at the bank. So you may not be aware of this, but Bank of America is the largest tax equity owner when it comes to wind and solar in this country. And so we worked with them to identify a couple projects in which we were planning to provide tax equity, and in some cases also do the hedge, where we could sign long-term contracts for the renewable attributes as well, so that they would contribute to this goal. We've also signed some long-term power purchase agreements, and we are focused right now on signing agreements that include electricity. So we have executed 2 of those. We're in the middle of our 3rd. And in addition to that, we're also looking at green tariff programs, where it's a similar situation where we can also support new renewables and contract for electricity and, of course, RECs. And then the final components, obviously, we're a global company, so we are looking for long-term opportunities outside the U.S., but are also purchasing those renewable instruments in the various countries and regions in which we operate. And then we've also carved out a little unique piece, which I think is interesting considering the audience today, where we have supported small projects and signed long-term REC agreements to help them come online. So somewhat supporting distributed energy really in all underserved communities. In some cases, these have supported co-ops where the co-op members have received a discount as a result of the project. And we also have mandated on our last 8 contracts we've done in this space that all of them have pollinator habitats installed. So one thing that we're always thinking about, whether it's renewable electricity or carbon credits, is how can we really maximize the environmental benefit? And especially adding in that social benefit is important to us as well. So the next slide leads into how we approach carbon credits. So we actually did this work last year. And again, similar to what we did with the renewable goal, we took the time to develop a mission statement. So you'll see that here. And ultimately, the key components here is that we wanted to support, of course, verified carbon offset projects, again, driving innovation, and ultimately, as I just stated, maximizing those environmental and social benefits. And so in addition to that, because this is such a growing market and things are changing, and it was our opportunity to really dive deep and begin to understand the market, we wanted to make sure that we also outlined some guiding principles. And so I highly recommend this because you're likely going to look at hundreds of projects as you look to make choices around what you want to support. So just a few highlights in this list. Obviously we wanted to make sure that these were science-based solutions. We also examined and wanted, due diligence even above and beyond some of the requirements with certification. We wanted projects that connected to multiple sustainable development goals. And we also used Project Drawdown as kind of a reference as we look through projects as well. And then, of course, for us, we wanted to make sure that there was deep community engagement and community opportunity as a result of the projects we chose to support. And then, of course, just long-term viability. And so with that, we chose 4 projects. And if we go to the next slide, you'll just get a high-level view of kind of these projects. And I apologize there aren't any great pictures because, of course, these are excellent projects. But we chose to support one in each of the regions in which we operate. And we did make kind of long-term commitment to these projects. So they will supply us with offsets for the next couple years to maintain that goal that we have. But you'll see, you know, it's a combination. Certainly they are all natural climate solutions. Some are kind of restoration, conservation, and then others are active tree planting. But you'll note, you know, tried to capture some of the key components here when we talk about connecting to SDGs or driving additional social benefits or community engagement. Every single one of these projects accomplishes that. And so with that, I think that was all I wanted to cover today, and I look forward to your questions.
Great, thank you so much, Beth. Well, with that, I'm going to stop sharing my screen and hopefully we can go back to videos for everybody. So thanks. I've seen a few questions come in. If you do have more questions, feel free to address those to the panelists and we will get to them. Kevin, I saw the first question that came in was for you, and it asked, could you talk to any challenges that COVID has had on offset project development?
Sure, happy to speak to that. You know, when you're making an investment decision, which is what an offset project development decision is, those decisions, they don't look too fondly upon uncertainty. They really like certainty to drive these decisions. There are real dollars at play and some long-term needs from the market to justify the investment. And so I would say when COVID first hit, it was a real, you know, hang on to your hats moment because there was a lot of uncertainty introduced. And so I do think there was a pause there temporarily of project investment decisions. However, I will say this, that I think, you know, 6 months into it now, the opposite is true, because as David pointed out, there has been remarkable resiliency proven from these markets. And so if anything, just the short-lived nature of the uncertainty and the fact that I think the world has realized, or at least our world has realized, that this topic of climate action is not dead. It's not going away, and it's not a luxury that people can choose whether or not to invest in, depending on if they have, you know, excess money in their budget. Those issues have been proven not to be the case. And so the resiliency that the market has shown, I think, has bolstered confidence in making these investment decisions. So I might actually say, I might go out on a limb here and say that it's been good for project development.
Thanks, Kevin. A related question that is for Verra and/or Bluesource. What trends have you seen in voluntary carbon offset pricing this year? And I know, David, that Verra does not see pricing, so perhaps Kevin can speak to that first question, and then I'll move on with the remainder of those.
Happy to address this one as well. As David pointed out in one of his slides, it's not just all about carbon. There are many other factors that differentiate one ton from another. People often say that a ton is not a ton is not a ton. And with respect to certain offsets, I would say that there has been no effect from COVID on voluntary offset pricing, that it has only continued the trend that we've seen over the last few years of strengthening price. The demand really hasn't softened for voluntary carbon in most categories, and so that price continues to trend upward. However, you know, with respect to CORSIA, there are some very real changes happening in that program as a result of simply people just not traveling. And there have been baseline adjustments, and there is definitely a change of perceived demand from the pre-COVID times to where we are now about what airlines are going to need for compliance with CORSIA. And that has generally been not a good thing in terms of demand. And so I think that for offsets and offset projects that were really earmarked for CORSIA and making that, you know, the main bet of the near term, I think that those prices have likely softened quite a bit.
Thanks, Kevin. To move on to the remainder of the questions from that attendee, The question is a loss of pre-CORSIA demand from airlines due to ICAO's baseline changes weighing on prices, or have values picked up on stronger demand from other sectors?
Yeah, I think I can just bolt on to what I was just saying before. I do think that it's really the former. It's that they are weighing heavily on prices. They are helped to a degree by what's happening elsewhere in the voluntary market, but probably not to the extent that developers of those credits were hoping.
Lizzie, I can just chime in on our projects if you want. I mean, we have seen those 4 projects, at least 3 of them, the prices have increased. So we made purchases the end of last year, and because of demand, the prices have increased already.
Thanks, Beth. That really does answer the last part of the question there, which is, what do you foresee for voluntary pricing trends up until Article 6 rules for the Paris Agreement are decided? And we don't really have a crystal ball, but that is interesting to note that you've seen prices go up as of late.
Sorry. I would just add to that I don't think that the lack of rules on Article 6 is having any hindrance on voluntary activity. I think there's a question mark as to whether the rules in respect of corresponding adjustments in particular are going to be required for voluntary transactions, and that may cast a bit of a shade on the voluntary markets until that issue is sorted out. I'll just be clear that we don't think that, I don't think that that's necessarily the case, but I think, the lack of Article 6 rules, I don't think has really stopped the voluntary carbon market from moving forward.
Thanks, David. To kind of piggyback on this conversation, there's a question: if you had to make a prediction, how large will the voluntary carbon offset market be in 2025? David, that might be a good one for you.
Yeah, I just don't like to speculate. I mean, I think it'll be bigger, but I think a lot of it depends on a variety of factors. I mean, the reality is that the voluntary market exists today because governments are not stepping up, right? And companies all over the world are saying that climate change is a problem, it's a crisis, governments are not doing their job, so we need to step in and help solve this problem. So, if, and believe me, we would be delighted if governments around the world said, let's get our act together, let's really ratchet up the ambition under the Paris Agreement, let's get on top of this problem and put ourselves on a pathway towards a 1.5 degree world, then maybe the voluntary markets may not be such a huge thing in the future. I don't think that's likely. I do think it's more likely that governments will continue to drag their feet, and so I think that there's still plenty for voluntary activity, and even if governments do step up, I think that there is, and maybe you guys can speak to this, Beth and Kevin, that this has helped shape, if you will, how companies see their engagement in the world. Even if governments were to step up and basically make sure that we're on path towards a sustainable world, my guess is that voluntary offsetting wouldn't necessarily go away. I think it's now somewhat been baked into to corporates that this is part of what they have to do, and there's pathways for them to do so. So I think it would be very hard for that to back, but I'd be curious to hear what you guys would.
Yeah, I mean, I think you're only seeing companies ratchet up their ambition, right? I mean, we're finishing out 2020 goals. Our goal has been carbon neutrality for Scope 1 and Scope 2, but you're seeing goals now that are including Scope 3. And Scope 3 is really what's going to drive the voluntary markets. And so I think as you see more companies setting net zero or, carbon negative, which I think now there are 2 companies who have done that, by 2030. And, the definition isn't completely defined for net zero yet, but what we're seeing people make these commitments. And that's what I think is going to drive the voluntary market. The more people get their arms around Scope 3, there's so much we can do to reduce, but we will ultimately have to use offsets to get to these aggressive goals over time. So.
Thank you. We had a question about What would you recommend to small-scale projects on how to be taken into account for larger companies for carbon credits / renewable energy certificates? Overcoming the transaction cost for carbon credits has been a problem for small projects for many years. There have been streamlined methodologies for that. But David, do you have any thoughts on recommendations for small-scale project developers?
Yeah, I mean, it's a perennial problem, right? We've actually kind of changed our fee structure. We might even do more to make it more friendly towards smaller projects. You know, but the perennial problem we always get is like, how can we kind of reduce the cost to zero? And that's impossible, right? At the end of the day, you know, companies like Bank of America, they know that there's some third-party auditor behind us and that there's some sort of rigor behind the system in order for it to be able to be transactable. So, you know, we do what we can. And I think, you know, in the end, I mean, what I would hope is the answer is that with more demand, you'll start to see increasing prices, and that will then enable smaller projects to start to participate. But, you know, there are some, you know, there's a number of smaller projects that do operate. And, you know, we have rules that allow projects to do grouped approaches where you can add different instances. So the auditing costs are reduced greatly for those. There's standardized or streamlined methodologies that can be used to more quickly enable the registration of projects. But, you know, if anybody has any good ideas, we're happy to consider them. We just started a new working group on forest carbon offsets. And, you know, so we're always open to suggestions from folks who would have good solutions to problems that we have to work on every day.
I really enjoyed Beth's mention too of the purchase of RECs from small distributed generation. Now that granted is outside of the carbon world, but in that it's supporting renewable energy, but that preference for those small scale projects was a really interesting thing to note. Question for Beth, can you say at what price level Bank of America has paid for offsets in the past or anticipates going forward? For reference, Boston Consulting Group today announced it will pay $35 in 2025 and $80 in 2030 for credits from nature-based and engineering carbon removal projects as it seeks climate positivity or carbon neutrality. So any thoughts on if Bank of America would pay that for offsets?
Well, I think, you know, certainly we did not pay that last year. But, you know, the difference, and I think David was kind of alluding to this, you know, carbon credits are not at the social cost of carbon right now, right? They have a long way to go to even get to that component. So, you know, we are certainly supportive of that. And, you know, we've already, like I said, seen the costs go up exponentially. And so, you know, we're committed to this and we're committed, you know, to these projects, and we're going to continue to find, you know, other projects to support as we increase our ambition, et cetera. And so, you know, I think we're going to, you know, follow the market, and, you know, ultimately we do need to be aligned with the social cost of carbon. So.
Thanks, Beth. I have a question, David, for you. Do you think the drop in issuances that you saw in April could be due to the impact of COVID on both verifiers and registries in terms of their ability to have projects reviewed as those employees transition to working remotely? And as a follow-on, is VCS allowing remote verifications by video during this time where travel restrictions and preferences to not travel exist?
Yeah, so I mean, the answer to the second question is yes. We ask project proponents to communicate with us and explain, you know, why they would need to do it remotely, and we've got procedures in place for addressing that. And I don't really know what the reason is for the drop. You know, the issuances in any one year go up and down. And I don't know if the drop in March coincided with just the way it was happening, and there was a large leftover from the previous year that people were transacting in the first 3 months, and then it dropped in April or not. I don't think it had to do with verifications not taking place, because I think that the verifications that had been done were already kind of in the system, right? So if a verification had been done, had been submitted to us, we were reviewing it, you know, those issuances of, you know, before COVID, it was really mid-March, you know, would have played out through April. would have been kind of acted on. So I don't think that those have to do with COVID directly, but I could be wrong. I don't know. I haven't spoken to every single project developer to understand, you know, in fact, that's not even speaking to the project developers that did issue, it's speaking to the project developers that did not issue. So that's a huge undertaking. So I've got to say, I don't know. And I'm sorry to say that I can't answer that question.
No problem. This is a question for Beth. The Center for Resource Solutions has a Green E climate certification that acts as a mega standard over some of the existing standards like VCS, ACR, and CAR. And that is kind of a standard that supersedes those others. And for Bank of America, Beth, was Green E certification a factor in the carbon offsets for the project in the US?
Sure. So first I will say, so we are very supportive of Green E for our REC purchases. So we only purchase that standard where available, and outside of the US, we apply that standard to all of our purchasing. And we also are part of the Green E marketplace program. So they also third-party verify us for our North American purchasing as we make claims to our consumers and things of that nature. So we did not utilize them in the purchases of carbon offsets. We reviewed all the different standards and kind of prioritized the ones that we wanted to focus on first. I believe, you know, as we continue to make purchases, that's something that we'll, you know, consider and explore, but we did not do that for this initial purchase.
Thank you. This is a question I think directed again towards Beth. What sections of Project Drawdown have you considered investing towards? There are a lot of amazing initiatives they've highlighted within their book. And just to note, I believe the #1 project under Project Drawdown has to do with HFC reductions. And so just curious if that came on your radar for projects to support.
Sure. So no, it's a great question. So, you know, Project Drawdown sits on my desk, by the way. So I use it as kind of as we look to prioritize and focus what we do across our operations, et cetera. So we chose not to, one, purchase renewable offsets, and two, you know, methane, landfill gas, you know, anything kind of in that industrial realm, we decided not to purchase this initial time. We wanted to focus essentially on nature-based solutions. You know, that strategy will continue to evolve, but that's what we wanted to do now. And so we, you know, specifically, I would say one of the things that we did pull out of Project Drawdown was supporting peatland conservation and restoration. So that, you know, was one of the projects that we were really excited about in Indonesia. So yeah, we didn't really include anything industrial in this first round.
Thanks, Beth. This is a question perhaps for David, and also Bluesource does have some history in this. It says, for carbon capture and sequestration projects that demonstrate permanence, verification, and performance guarantees, and done outside of compliance programs, how might the market view these types of offsets? And I do know there is an ACR protocol that allows for quantification of offsets from CCS projects. And David, I don't know if you want to speak to that with regards to VCS's adoption of the CDM CCS methodology, but there are methodologies that allow for quantification of CCS credits. David, you're on mute, just so you know.
Oh, sorry, thank you. Yeah, I think, you know, all CDM methodologies can be used under the VCS program, but I think that in respect of CCS, there's an issue about how you would calculate how you would address the non-permanence of it. For one, there may be other issues. I haven't looked into it directly, but, you know, when we look at permanence for nature-based solutions, we require each project to look at the risk profiles of the project. And the risk profiles tend to be about internal management of the project, external forces like political conditions, and then kind of natural climate issues like, you know, exposure to hurricanes or wildfires, etc. CCS is a little different. There may be kind of a technological aspect to how confident one can be that the CO2 is going to remain underground. So I think, you know, our rules would need to be updated and thought through in the context of those challenges. But it's certainly, I wouldn't say no, but it would require some thinking about how you'd actually go about ensuring the permanence of such credits.
Thanks, David. I think too, given the price of voluntary offsets and the cost of doing CCS projects, that can be a barrier. However, there are incentives through 45Q right now, but it would be interesting to see if both offsets and that financial incentive could be used and still demonstrate financial additionality for those projects. I think this is our last question, and we'll try to keep it within an hour today. Does Bank of America outsource to larger companies to help manage their carbon credit projects, or do they manage it in-house? And to what degree do large corporations do this in-house?
Great question. So we did it in-house. I think it's probably a combination, but yeah, we chose to do it in-house, and thankfully we do have some expertise. We do some trading and compliance markets. We used to have a trading desk in Europe, and so we kind of leveraged those expertise and educated ourselves, and yeah, so we did it in-house.
Great. Well, I want to give a huge thank you to Kevin, Beth, and David today for joining us, and thanks to everyone who was on the line. Feel free to share the recording with colleagues when you do get that in your email, and we look forward to seeing you on our next webinar, which will be on renewable natural gas in late September. So thanks everyone, and have a great rest of your day.